Welcome to Crossroads. A new report shows that businesses in China are seeing their profits plunge to record lows. Now, according to a new report, only 66% of U.S. businesses were profitable in China last year. And this is not just limited to the United States. Even European companies are watching their businesses fall like this in China as well. The latest development, notably, it's dashing the beliefs that the market is going to improve. That's having a ripple effect, of course, through investment. But new CCP policies also that favor domestic companies, their tumbling economy with real estate and the banking crisis, and also an expanding global trade war, all of this is coming together and really taking the toll on the country. The development could also accelerate the process of companies leaving China because they're facing diminishing profits, which could likewise, again, have kind of a domino effect through investment and then to the economy again overall. Now, for U.S. businesses in China, they're especially being impacted. This is according to a new report released by the American Chamber of Commerce in Shanghai on the business climate in China. They're saying a few factors, including increasing geopolitical pressure, China's economic slowdown, all these things are contributing to a, quote, less optimistic outlook for China. Here's some of the exact numbers about what is happening to these businesses from the American Chamber of Commerce report. It says this: only 66% of U.S. businesses were profitable in 2023, again in China. This is a record low according to the report. It says that 47% of the respondents are optimistic about the 5-year business outlook in China, while 13% of respondents ranked China as their headquarters top investment destination. Both rates are the lowest in our survey's history, ever. And notes that over 2/3 of companies are following a de-risking strategy, with 36% investing in supply chain resilience and 25% segregating China and non-China data and information. What does that mean? It means they're making sure that if the Chinese economy collapses, it doesn't destroy their business. When they say de-risking, it means they're removing the risk of being too closely tied to the Chinese economy so that as things go further down, it will not put them out of business as well, right? And when they talk about segregating the China data and the non-China data and other information, it means they're basically building two separate empires, so to speak. Not to mention when they talk about, again, investing in supply chain resilience, that means also imagine, if you're working in real estate development and you need iron. If you're working, for example, in some kind of computer technology and you need rare earth minerals. It means you need supply chain resilience. If the CCP cuts off the supply to something, you have other places to go. They don't see the CCP in China now as being stable. And it's a record high of 25% cut investment in China last year, but only 20% expect to do it this year. And notice the top reasons for members decreasing investment is concerns over China's, quote, slowing growth. And note as well that opportunities in other markets are the reason why 40% of members are redirecting planned investment, with Southeast Asia and the Indian subcontinent being the most popular choices. They can manufacture just as cheap, just as efficiently somewhere else. Why keep it in China? And that's what they're saying. It notes as well that only 22% of respondents expressed confidence in the Chinese government's commitment to further opening up their industry in the near future. Because aside from everything else, the CCP is focused on domestic production. They want Chinese companies, not American companies, not European companies, not anywhere else. They want Chinese companies. And with this trend, we also see some businesses, just moving out of China. The Epoch Times said this: IBM has decided to follow the example of what has become a long list of American brands and close some of its operations in China. And note that although management has remained very businesslike in its statements, right? They're trying to be diplomatic. It has clearly read the same writing on the wall as other American firms. If this is an inconvenience and an expense for the firms moving away from sometimes decades-long arrangements, it hardly helps China to lose the expertise and business acumen of these operations. Now, what's even more interesting is, again, this is not just an American issue. It's not just the CCP going after American businesses. This is a trend across the board. And we see this notably happening with European businesses. There was a report that came out with very similar findings for European companies in China. This was from the European Union Chamber of Commerce in China and their latest position paper. They said this. They said the central concern for European Chamber members is China's economic slowdown. However, several other factors are dragging on business confidence, including perennial market access and regulatory barriers, meaning the CCP is kind of cutting off their access to the markets, and Chinese regulations are making it hard for them to do business there. Again, the CCP is favoring domestic companies, not foreign companies. And as well, a highly politicized business environment where the CCP is kind of bringing back more state control over economic sectors, which includes not just businesses, but also investment and banking in the whole 9 yards. And also lackluster domestic consumption, overcapacity, the persistence of ambiguous rules and regulations, and the government's continued focus on national security and developing a high degree of self-reliance. They don't need nobody else. They want Chinese companies. And notes further in that a sentiment is emerging at company headquarters and among shareholders that the returns on China investment are no longer commensurate with the risks faced. It's not worth it. And notes that profit margins in China are equal to or below the global average for approximately 2/3 of European Chamber members. And pessimism about future profitability is at an all-time high. In other words, the costs of being there are very high. The risks of being there are very high. And the benefits of being there are kind of low. There's not a lot going for it. And so that's raising the question, well, why are they there? Why are they doing business there? Why are they putting their headquarters there? Maybe they want to regard it as a market to sell products in, but do they need to be fully embedded there? That is what the question is. Now, like, the writing for this has been on the wall. We pointed out previously, including on this show, the Chinese Communist Party, they were expected to announce a solution to their economic woes, right? We watched the Chinese banking crisis, the runs on the banks, people getting arrested for doing so. We watched, of course, Evergrande and all these big Chinese real estate companies start to go under. We watched the CCP saying, we have a plan, right? And what happened? Well, they had their recent third plenum meeting and a top-level Politburo meeting, and that was expected to come out with a big announcement of the solution, right, for the Chinese economy, how they're going to save it. And what happened? Well, the Chinese Communist Party came out with lofty-sounding statements on how they're going to be like, the future world power and so on, and all their plans of, what they want to look like, but they didn't propose any actual steps to achieve that. There was no actual proposal on how to fix the problems. And, it wasn't even just the China hawks saying this. It was the mainstream news outlets. This was investment groups calling it out. People were noting the CCP presented no actual steps for solutions. And even then, you still had some people who were maybe hopeful. You still had some investors saying, well, we think they have a plan, and they're just not telling us what that is. You got to invest to find out what it is, right? And they found out what it was. They found out the CCP actually does not have a plan, and the plan that it does have involves pushing them out for the most part. What the CCP also did alongside of this was declared a focus again on domestic production. They have a goal, stated publicly, to replace even outside technology on every single system. They don't want Windows, right? They don't want American operating systems. They don't want American software. They don't want anything from any other country being used in their country that they have to rely on. And if they're relying on it, they're looking at how to replace it. They're not looking at how to buy it. Now, the important thing with this is that means that foreign businesses are facing a diminishing future in China. Now, here's more on this from the European Union Chamber of Commerce's position paper. They say the foreign business community had been looking to the third plenum of the Central Committee of the Chinese Communist Party for signals that at least some of these concerns would be addressed. And they say this: instead, The third plenum decision, again, this top-level CCP group, continues to promote investment in manufacturing as a key driver of China's economic development, albeit under the moniker New Quality Productive Forces, right? That's a CCP slogan. And they say, i.e., the aim is to increase production capacity in strategic, higher value-added goods and technologies. They note the intention to step up efforts to develop a complete domestic demand system is asserted, but the document contains nothing concrete as to how consumption will be stimulated. How are they going to make the Chinese people start spending their money and buying? That's the big question, and the CCP is giving no answers on that. And it's not just that. The CCP has been taking some pointed actions at European businesses. I'll be talking more about how China has been doing this in the international business space after I come back from a quick break. Welcome back. Foreign businesses are seeing record drops in profits in China. Now, this is amid the geopolitical tensions and slow growth in the Chinese economy. It's not just U.S. businesses facing this either. Even European companies are watching their profits in China get impacted. This is as China, the CCP, turns domestic focus to domestic production, and a goal notably to replace basically anything they get from the outside, including technology and any kind of reliance or dependence on outside businesses. And outside countries are doing the same thing to the Chinese market. But with European businesses in particular, the CCP is taking some more pointed actions. ABC News said this. They said in August, China filed the complaint with the World Trade Organization over European Union tariffs on electric vehicles made in China. It also launched anti-dumping and subsidies investigations of European dairy products, brandy, and pork exports. The tit-for-tat actions have raised fears that a trade war may break out. Many European businesses are deciding that their returns on investment in the world's second largest economy are not worth the risks due to issues including China's economic slowdown and a politicized business environment. Now, briefly on that, you might remember the European Union put tariffs on Chinese electric vehicles. Why did they do that? Well, the CCP overproduced them. They had overproduction. They had too many of them sitting on the shelves. They needed to get rid of them, and so they wanted to dump them on foreign markets at a significant price drop. The problem with that, because Chinese businesses, many of them are subsidized by the government, especially EVs and other things like that, things they want to compete with in future markets. They want to sell them at prices that nobody can compete with because they don't need to make profits. They are propped up artificially by the Chinese Communist Party. The CCP does that, right? They cut the prices, they sell below the red line. Businesses can't compete. The CCP puts its competitors out of business. And when the competitors go out of business, the CCP then has a monopoly on the entire industry. Once they have the monopoly, they can buy up their former competitors or become, majority investors. They then have a global monopoly within an entire sector. Now, Europe, the United States, many other countries, they don't want that happening. They want to make sure the CCP doesn't control the future of vehicles. They want to make sure the CCP doesn't control the future of technology that, again, we're going to be needing for the world. And so they say, no, you can't have this if you're going to be subsidizing it. You can't be selling below the red line to put us out of business so you can have a monopoly. So they hit back. They made it so the CCP couldn't do it. The CCP now being very angry about that is saying we're going to do the same thing, and they're going after milk or pork products and things like that. Now, for the EU as a whole, that's not that big of a deal, but for individual EU member states, some of them, that's a big market for them. And so the CCP is bypassing the EU, going to individual countries and trying to strike trade deals to get around these tariffs. And that's where things are at right now. But interestingly, the general signal, right, seems to be that what the economy for China is going through right now, it's going to get worse. And so even aside from the trade war, there's more to it. Add to that the growing sanctions and tariffs from inside and outside, the CCP's growing role in global conflicts, think Russia, Ukraine, think Israel, think the South China Sea, Taiwan, possibly now the Arctic. And you can see where the trend is heading. Now, back to that European Union Chamber of Commerce position paper. Here's how the European businesses are reacting to that. And, perhaps maybe a bit hopeful where they're coming from. Their recommendations they're giving for China. The European Union Chamber of Commerce paper says this. They're asking the CCP to, quote, enact legislation to establish a truly level playing field between foreign and Chinese enterprises, improve the predictability and reliability of China's regulatory environment by ensuring legislation is specific and clearly defined, and drafted in consultation with industry, refrain from erratic policy shifts, and allow reasonable transition times before implementing new or amending existing policies or regulations. Permit access to legitimate sources of data and business intelligence that companies need to make well-informed investment decisions. Refrain from punishing companies for the actions of their home governments. So what they're doing is they're kind of like asking the CCP to not be the CCP. The feasibility of these recommendations in communist China are it's basically slim to none. The CCP is going to accept this. The Chinese Communist Party is not going to change its nature. The CCP is not going to back off on its entire economic plan, which favors domestic production. The CCP is not going to adopt, clear and straightforward laws because it uses those gray areas as a way to control foreign businesses, to make them over-censor, for example. And it's not going to back off all the international trade wars and other conflicts growing just because a few businesses that it doesn't even seem to want right now are complaining about it. Now look, the CCP, the trend right now is actually going in the opposite direction. The Chinese Communist Party is becoming more aggressive. And not only that, the CCP's priorities are not on these European businesses. The priorities are on domestic production, independence from foreign markets. They don't want to be reliant on anything outside of China. And so the likelihood that the CCP is going to adopt the demands of these European companies, it's about slim to none. Now, what's also important is that the trends we're watching, they're very likely going to have kind of a compounding effect with each other. Now, the important factor here is investment. If businesses leave China because business is bad, what message does that send to investors? Investors say, well, geez, this business we're investing in is leaving China. They're probably going to have a hit to their market because they're losing a market. Do we want to invest in them? The CCP has domestic policies that no longer favor this business. What's going to happen to them? Now, if China loses investors, that also means, importantly, less money in the economy. And the problem they're having with a lot of these businesses, just aside from everything else, is lack of consumption. People in China are not buying products like they used to. And in business, that also means people have less money to spend. Because again, where do people get their money from? Well, they work in companies, the company makes a profit, they get paid, then they can go to restaurants and go online and shop and buy other things, which means money goes to other businesses, which then goes to the employees, and that's how a normal, healthy economy works. But when people stop spending money, what happens? Money no longer goes to the businesses, money from the businesses no longer goes to the paychecks, and the people getting the paychecks no longer have the money to go and spend it. And you enter this death cycle. Now, investment sometimes can help you break out of that, but it needs people to spend, and it also needs some kind of hope in the future of the economy and for these business prospects to even want to go there. When that thing starts breaking down, that's when you enter what the CCP is facing right now. All of that, right? All the people not having money to spend, maybe people's feeling that they need to sit on their money and save it because it might not be there tomorrow. Well, all of this has an effect. It comes right back and hits the ability of people to spend money on products or businesses. And that cycle just keeps repeating. The result is like a thread being pulled out of a ball of yarn. The economy in China is unraveling through this. Now, CNBC said this. They said European businesses in China have grown so discouraged with the outlook for operating in that country that Beijing, the CCP, must act if the companies are to invest further, according to the EU Chamber of Commerce in China. And they said, quote, "We do believe actually that we are in sort of a tipping point situation. If you want to do something, the time is now. That's according to Jens Eskelund, president of the chamber, telling reporters ahead of the paper's release. And notes as well that foreign direct investment into China fell by 29.6% during the January to July period versus a year ago, according to China's Ministry of Commerce. It notes as well that it attributed to the decline of last year's high base. Now, we're also seeing this reflected in warnings on the other end of those businesses. Because look, again, it's not just businesses trying to make money in China. There are warnings also being issued to the investors to even stay away from companies if those companies are too embedded in the Chinese market. Bloomberg said this, quote, "Stay away from China-exposed stocks in Europe," Citi says. It notes as well that luxury goods makers, miners, car makers are seeing sharper cuts to earnings expectations than the broader market. And that won't change soon, the Citi strategist said in the report, which contrasted with last week's Bank of America recommendation. It notes that Citi's basket of European companies with high revenue exposure to China has fallen over 7% this year, a sharp divergence from the 6% gains seen for the Stock 600 benchmark. Now, notably, we also see this sentiment being expressed at government levels. And so consumer, business, investment, government, right? The United States, we're here, right? Policies against the CCP are becoming mostly bipartisan. And what does that mean? Well, normally for countries doing business with the United States, they understand that every 2 years with the midterm elections, every 4 years with the presidential elections, there's a chance that American policy will change. Because, we tend to oscillate between Republican or Democrat administrations, and there tends to be kind of a rotating policy system we have here. Things shift from one way to the other. The difference is when you have Republicans and Democrats aligned on an issue. And when it comes to China, Republicans and Democrats are relatively aligned. You have The Atlantic now, for example, saying that one of the few things that came out of the Trump administration, the whole trade war with China, the tariffs and sanctions that have now remained, that's one of the few things that Republicans and Democrats both seem to agree on. And we're seeing that reflected even now in the future possible administrations. It's unlikely that this U.S. stance on China is going to change, no matter who gets elected. And they're taking notice. And the European Union also, the EU, they just wrote about their stance on business with China. And it shows that the trend for them is, quote, de-risking. In fact, this is from the official statement just recently released from the European Union. This is from the official website of the European Union, their official stance on this. They say, quote, "China is the EU's second largest trading partner for goods after the United States, with bilateral trade reaching 739 billion euros in 2023. This represents a decline of 14% compared to 2022, and that was even a rough time because of the COVID lockdowns." They note at the European Council in June 2023, EU member states reaffirmed the EU's multifaceted policy approach towards China, outlined in its 2019 strategic outlook. They say this: China is simultaneously a partner, a competitor, and a systemic rival. However, the balance of challenges and opportunities presented by China has shifted over time. They say our economic relationship is critically unbalanced, both in terms of trade flows and of investment, due to a significant asymmetry in our respective market openings. Meaning, basically, they lose money doing business with China, and China gains more money than they do. It is more profitable for the CCP to get their business than it is for them to get the business of the CCP. There's a discrepancy here, right? The same thing America has, this trade imbalance with China. They note that in addition, China's economic model has brought about systemic distortions with negative spillovers to trading partners. According to the IMF, International Monetary Fund, China's use of industrial policies, notably its support to priority sectors, has an impact on trading partners. The policies of the CCP, in other words, are having an impact on the global markets. And, one of the hopes of opening up to China, when they said reform and opening up, and they let him into the World Trade Organization and other things, the hope was that if the CCP engages more with the free market, it would become less communist. And what happened? The CCP made the free market more communist. It went the other way. It notes here that another area of concern is China's drive towards import substitution and self-sufficiency, meaning they don't need nobody else. They want domestic companies to succeed, and they don't want foreign companies to have that market. They note that while the EU welcomes efforts by the Chinese authorities to attract foreign direct investment, they want money to pour into China, EU companies continue to face discrimination in the Chinese market because, again, they want domestic production. And they say, and it remains difficult for European businesses in China to compete due to the lack of a level playing field. Moreover, despite the Chinese government's stated ambition to pursue a high-level opening of its market and build mutually beneficial trade partnerships, China still remains largely closed in many important sectors. The CCP does not have a level playing field. In other words, they rig the game against foreign companies. They say this as well. The EU is committed to, quote, de-risking, not decoupling from China. They say this entails reducing critical dependencies and vulnerabilities, including in EU supply chains, and diversifying where necessary. So what does that mean? Again, diversifying, de-risking. What does that mean? It means getting risky businesses out of China. It means getting rid of the risk of, if the Chinese economy crashes, or if they really do want to push out all your companies, that you're not affected by it. They want to make sure that they're not dependent on the CCP. If the CCP decides, hey, we're going to ban all these rare earth minerals, we're going to ban iron, we're going to ban the ore you need to build your products. We're going to make it so that you can't build automobiles anymore. We're going to make it so you can't build any kind of high-tech goods because, you need us for it. If you want to build, say, solar panels or other things that need these rare earth minerals, well, the Chinese Communist Party has a global monopoly on them, and if they just cut you off, your business is dead. They want to make sure that does not happen. And so they're talking about de-risking, diversifying, looking at new supply chain options, right? Now, they say it's different from decoupling, and what they mean by that is they still want to do some business with China, but they don't want to be so in business with China that they depend on it. They want to have it so they don't need the business in China. The trend right here, right, is that it's becoming too risky for a business, for an investor, or even a country to place their bets on the Chinese market. And they no longer want to be intertwined with it. Even beyond that, if they're intertwined with it, there are warnings for investors to not even invest in those companies. It's becoming too dangerous, too unstable, and the future trend seems to be becoming more so. Well, everyone, that's all for today. Thank you for joining us. Let me know what you think in the comments. Also, please help share this episode. It helps get the word out. And as always, please take care of yourselves, stay informed, and stay free. Thank you.